So what are the benefits of going through acquisition? There are a lot. It will vary by company, but certainly it will expand and diversify your product or service offerings. That expansion could be geographical. It could be adding new products. It could be adding new services. It could be vertically going up the supply chain or down the supply chain. But most likely, you're going to be looking for companies that can diversify your product or service offerings. You may buy somebody that does exactly what you do. It may be, this may not be the main benefit, but at least you're going to increase the revenue size and likely pick up some customers that you didn't have before. Often buying a company is a way to break into a market that might otherwise be difficult. There might be some competition. There might be a high cost of entry in order to go into that market. But certainly buying a company is one way to overcome market entry barriers. As I just mentioned, adding clients to your portfolio is certainly very valuable. And quite often, particularly if there's a diversified product offering, you can cross-sell your clients with their products and their clients with your products. So it's a win-win when you buying a company that has new service offerings or products and new customer base. As I said, you may choose to expand into new geographical markets, which generates a new opportunity for revenue growth and also brings in new clients. It's also a good way to quickly grow market share. If you're a minor player and you want to have more presence in the market by buying another company, rather than trying to grow organically, it's a good way to substantially increase your market share. So those are the market benefits of looking at doing an acquisition. There are financial benefits of doing an acquisition. We've already said the acquired company usually generates enough cash flow to pay off the money that you used to borrow to buy them. But there are other benefits. Quite often there's some efficiencies you can generate and reduce overhead costs through integration. Particularly if you're in the manufacturing or product space, you may be able to have better leverage with your suppliers because now you're buying higher volumes. You may be able to bargain better because you're a bigger company. If done right, it spreads risks. For example, when you spread geographically, that spreads your risk over geography. If you're going into new markets, that spreads your risk over multiple markets. So the broader your geographical base, the broader your market base, the broader your customer base. If you have downturns in a geographical area, if you have downturns in a particular market, if you lose a customer or two, the broader you have customer base, geographical coverage, product coverage, it reduces your risk in running a business. And since we're talking about potentially maybe selling your company down the road, this would be a opportunity to increase the value to potential buyers of your company because now you have lower risk than you would have before. And as you get bigger, typically that may get you access to more and more capital sources if you need to borrow money. So those are the financial benefits. So if we talk about buying a company before you sell, Paul talks about the 1,000 days to really get focused on all this and do this before you sell. If the primary purpose of going through acquisition is to increase the value of your company so that you can sell your company, as I've said, it already diversifies the risk for the buyer of your company. It increases the size of your business and likely increases your valuation multiple. I will go in a couple of slides, I'll go through some math to explain even further why that's the case. And it also likely provides more resources, more cash flow, that if there are things you should be doing in advance of selling. For example, you decide you really need to upgrade your computer systems, your software that runs the company to a state-of-the-art solution. Now you have even more cash flow to be able to pay for those activities. So again, provides more resources and cash flow to fund business improvements.